1st. It's second half of the trading day, so I missed some decay value. But looking at last week to close it up, the week of 11/24 ended up at 53.41% annualized return because of TNA primarily. So looking at TNA, right here, we had we owned 300 shares and we sold calls with a strike of 45.50. We bought them at 44.50, and price rallied up past, so we got assigned. This says at what action at row over 117, cruise down here, and at 117 we choose this situation where we are assigned. So $300 is the profit on the sale, since we bought them for less than we sold them at. And so not only did we get premiums, but we got an appreciation in share value upon the sale, and so that's what pushed it up to 148% annualized, net gain of $382, putting in 13,000 for a 24. So that's a good. That was a good one. And then with BITX, we're still open, expiring this week, and SOUN, we're still open, expiring this week, and we also have some options that are in the money that we bought. So I'm going to go ahead and take a look over here. We're going to end up updating this, so 12/1, and I'm going to move these over because now we're going to go to TNA. We're going to go to next block for the value in, and then also for annualized return. And for BITX, we're still open here, so that doesn't change. I know the same is true with SOUN. So now we're gonna copy these down here. This will be 12/1, and this is 0 at the moment because I haven't done it. So with TNA, we sold our shares. We came out of everything with 13,598. So I'm going to go ahead and just use that to sell puts. So 13,598 is how much cash I derived after taxes. And I'm going to sell puts with 12/1, expiration this week, 12/5 likely. And let's put in what the price is. So we got TNA, the 12/5, it's 46.3 right now. So 46.3 to start off the week. And so we will, let's look at the chart in any given week. Let's do a 180-day chart. In any given week, it can drop. That's a good drop right there. So from 45 down to 39. So from 45 down to 39, which is 13%. So, and right now the mark is 46.3. So 46.3, and if we go down minus 13%, so 40. So I should be pretty safe if I choose a strike price of 40. And let's take a look here. 40, they're worth a nickel, so 0.05. We'd only be getting 5.74% annualized return on that first play with 3 options. So let's see what happens if we were to come up to 42.10. Now we're running a little bit of a risk, of course. Now we're at 11%. And 42 would have to drop 10% about to get assigned. And what I want to do is use, so I want to buy some puts at the same time and use this new feature that I just put in. yesterday. So if it were to close, so if I buy puts, the at the money price is about $1 for the buyback. So I'm going to put a little bit higher than $1. I'm going to put 110. 110 is how much it costs to buy back. So if I want to buy back these puts, that's what it would cost me. I'm only earning $30, so obviously we don't. This isn't complete yet. So frankly, it's feeling like I need to go ahead a week. So instead of 12.5, I'm going to put in 12.12, and let's go up to 12.12. Let me delete that. So 12.12. All right, this is looking a little bit better. So 41s are 46 cents. So 41.46. That's a little bit better. Of course, there's a higher risk for it to get assigned, but that's why we're going to buy some puts also. Same expiration, 12.1, 12.12, and we're going to buy close to the money here. So at 46, they're 193. So 46, they're 1.93. And if I just buy one, we're spending 193, we're making 138, so that's going to be upside down, of course. So that's too close. So we want to have, let's do 45 at 152. So 45s with 152. Yeah, we need to be above the 138 mark. And how many options? So I'm going to round this up to 16,400 so that we get a little bit more premium. 184, I'm spending 152, and we're making a 5% return. High likelihood that the bought put can get in the money. And to buy back, the buyback cost would be 400. The value of these puts that we buy would be 400, so we'd have to throw in some $40 in order to buy back completely, but we'd be able to roll to a lower strike. So that's the benefit of what we're doing here. Let me see what happens if we get a little bit more aggressive with this and choose, instead of 41.50 for 50 cents. So 41.50 for 50 cents. Our annualized, whoa, what happened? Oh, we'd have to round up to 16,600. So 16,600. And now our annualized is 7.45%. And our buyback, to put in $90 to buy back. And now we think about what's going on in the market. There's a bit of uncertainty right now if we look at the chart. Yeah, overnight. So there might be a little bit of downward pressure anyway, which means those puts would be in the money. I sort of like it. We're only making 7.5% annualized, but we're also putting ourselves in a position where this bought put can get in the money at 45 and has to drop all the way down to 41.50 for me to get to a point of wanting to sell it. So let's take a look here. Yeah, I'd have 4 of them. And let's, I kind of want to test out this system. So I'm going to go ahead and execute this. So I'm going to sell 4 41.50s for next week. So I'm going to sell 44 to open. $0.61. So good. It's a little bit better. Just communicating to myself that I did these things, and I'm going to buy 145 strike. So just buying one of them to open. Okay, and let's let this fill. All right, 149 is what it cost. So 1.49. So as a result, all right, we ended up at 14.75% annualized. Expirations are 12/12. This is now open. I'm going to put in the commissions now. We have a bought and we have a sold. Monitor and account statement. All right, our bought 66 cents and then 263. So 66 cents and then 2.63. So our commissions are in there now. Drops us down to 14.24% annualized. And now if the mark drops to 41.50, I want to buy back and sell basically at the same time. But I might roll it. So, and there's no urgency. It's not going to drop down like drastically all of a sudden. If it did, then these would be in the money anyway. This one put that I bought. So, and I'm just thinking about a conditional order, but I don't want to do a conditional roll. So I'm just going to leave that as it is, and it's open. And so now looking at BITX, we have this expiration on 12/5. Let's see what the current price is. 27.5. 27.5. We sold 34s. Unlikely it'll get up there. But we also bought some calls at 31. They're not in the money. And we don't want to get assigned because our average price per share on purchase was 52. So I would be buying these back or rolling forward. I would be rolling forward before we get to that point. Those, well, actually this expired anyway. I already got rid of them. Yeah, at that price. I already dumped those. So I'm just a little bit exposed right here. And I would just want to roll this up to a higher strike price in a future date. If it were to threaten that 34 mark, that's looking pretty unlikely. Now going to SOUN. We have, it's at 11.87. And we sold 14s. We got them at 18.50, so we don't want to get assigned. If it starts coming up, then this starts getting in the money, and we could use some of this appreciating value to roll the sold calls up to a higher strike price and further out expiration date. And so we're looking. This was just a 9.77% annualized, and so we'll just wait to see how this plays out for this week. And so coming back to our study and summary, now that TNA is in here, we find that we're at a 15.57% annualized return for this week, and that can change if any of these options that we bought end up in the money. I want to now do this. It's like a crash hedge feature where in this case I'm going to buy calls when the UVXY So this follows the VIX. If this comes to a spike, if this starts spiking upwards, then it's likely that it'll continue up, just like if we look at the 180. Wow, we're all the way out to that far. See, it can spike up like that if there's a geopolitical or, well, this was the tariff tantrum. So I want to be able to capture value on its way up. If it gets to the 70 mark, chances are it's going to continue up, because up to 70 is already pretty high. Looking at 20 days here, see, for it to go up to 70 rapidly, it's probably going to keep on going up. So what I'm going to do is, let's see what I'm looking at, 1219. So I'm going to go to 1219, and for a 70, I'm looking to buy 5 to open, limit price of 4, and I'll show you how I came to that. Good till canceled, but only under the condition that UVXY itself, this time I'm using UVXY instead of QQQ, when it itself gets to 70. So it's like when it's at 70, you're talking about buying calls at the money. And so to review, buy 5 December 19 70 calls with limit of 4 when UVXY itself goes up to 70. I'm going to save that, confirm and send, and I want to show you why I chose that is because the buy price now for those at the money calls is 370. So as the mark rises all the way up towards 70, these values are going to increase towards $4, and that's why I set the limit at 4, because I don't want it to end up, filling at a crazy amount, just in case it were to not fill immediately. So it's set the limit at 4, and so this is now active, and it's buying 70 strike, which is 32% above what it is now. Expiration 12/9, quantity of 5. It'll cost me 2K, and then what I'll do is since I will own see if I can work this out. So since I will own these, I'm going to want to sell. Let's see if I can set a sell 5. It'll be to close. Set the 70 calls at the market price, but only under the condition that, actually I don't want to do market price. I want to do trailing stop. So if it peaks, when it peaks after crossing 70, once it comes down 5%, it automatically sells. That way I capture as much value on its way up as possible. But I'm only going to own these after it goes past 70, because that's when the buy happens. And so the assumption is that this is going to be past 70, but now I don't want this to trigger until it's past 80. I don't want this order to go in. So now it's saying sell 5/19s, which I'll own at 5% mark when it's that high. So it'll show wait condition, and I'm going to hit save, confirm and send. And so now those two orders are in there. And so that's kind of a hedge that I have in place now. And so I will, now we're just going to kind of watch what happens here. So this is set. This is post execution. This is set. Trigger is set. Okay, it is going to be a trailing stop of 5%. All right, so that's it for now. But 15.57% annualized is pretty good on the week. Okay, closing out.